So the Dow hit its highs of the day in the moments after the Fed announced its rate decision. As expected, policymakers kept rates unchanged. In a statement, the Fed said it would be patient. It would be patient with rate rises and is prepared to use a range of tools to steer the U.S. economy. Moments ago, the Fed chair said policymakers were reacting to economic data and political developments, like, for example, the U.S. government shutdown, trade discussions, and Brexit. I want you to listen to what was said.
Today, the FOMC decided that the cumulative effects of those developments over the last several months warrant a patient wait-and-see approach regarding future policy changes. In particular, our statement today says, in light of global economic and financial developments and muted inflation pressures, the committee will be patient as it determines what future adjustments to the target range for the federal funds rate may be appropriate.
All right, to help us make sense of all of this, Mohamed El-Erian, the Chief Economic Advisor at Allianz. Mohamed, thank you so much for being with us. So, Fed obviously decided to hold the Fed funds rate steady between 2.25% and 2.5%. What does that tell you about their assessment of the sort of general economic environment?
So the assessment of the general economic environment is that the balance of risk has shifted to the downside. And what they did is they delivered exactly what the markets were looking for. Two things in particular. Like you said, patience on rates, and secondly, flexibility on balance sheet reduction. Gone, completely gone is the notion that was stated just a few weeks ago of the reduction being on autopilot. You know, when investors hear these two things, markets react in a textbook fashion. Higher stocks, lower interest rates, and a weaker dollar.
So overall, how optimistic is the Fed about the state of the U.S. economy specifically?
So I think they remain optimistic, and for good reason. The labor market is very strong. We got another indicator today that surprised on the upside in terms of job creation. Last week, we got the lowest jobless claim in almost 50 years. So the U.S. economy is in a good place. Yes, growth is going to slow because of the partial government shutdown, but that's going to be temporary and reversible. The concern has been spillback from weaker momentum in Europe and in China.
So really, you know, weaker momentum around the world just in terms of slowdown in global growth and also volatility in the markets really forced Jerome Powell to look and say, listen, it's important for us to sort of brace ourselves and be more patient. Remember, patience was really the buzzword today.
It is, and I think of the Powell-led Fed having learned what the Bernanke-led Fed learned, what the Yellen-led Fed learned, which is when push comes to shove, markets lead the central bank, not the central bank leading markets. They tried to lead markets, and the result of that was a very messy sell-off that risked contaminating the economy. Now we're back to the old regime, and what you're going to hear over and over again in the markets is the notion of a Fed put, that the Fed is there to support us. And that's why stocks are doing so well in response to the statement.
So let's talk about earnings. Obviously, we're in earnings season, and there is fears about sort of companies that are heavily exposed to China. For companies that are exposed to China, I mean, obviously, Boeing did very well despite their exposure to China, but for companies generally that are exposed to China, is winter coming, essentially?
It's certainly going to be colder. You saw this in the Apple results. It's going to be in the Caterpillar. Be careful, Boeing, because Boeing has lagged orders. So you don't see an immediate response. You know, the Boeing results were terrific, but I wouldn't read too much into what they tell you about China. I think that the ones that are exposed to China on a high-frequency basis are sensing weaker demand, and Apple said so very explicitly yesterday.
Do they need to look at other emerging markets for gain? So, for example, Apple obviously being heavily exposed to China, do they need to look at countries like India, for example, that also have, you know, sort of high density population as well for future gains?
Oh, absolutely. I think that this is serving as a reminder of don't over-rely on China. China is a very big market, but you don't want to be overexposed to China. You should look elsewhere, Brazil, India, Indonesia. There are lots of other possibilities, and I would diversify among the emerging economies, and I think most companies are trying to do so.
All right, Mohamed El-Erian, live for us there. Thank you so much. Appreciate that.